Hey, good morning, everybody. Thanks for having us. I'm Matt Harnett with Tecum Capital. We're an SBIC fund out of Pittsburgh. We support independent sponsors. We've done over 100 independent sponsor transactions and have invested over $1 billion of capital across 4 different funds, specifically supporting independent sponsors like Tony and family offices and groups like them. So good to be here. Tony, can you please introduce yourself? Tell us a little bit.
Yeah, happy to. Good morning, everyone. So I'm Tony Brindisi. I'm one of the co-founders and managing partners of RTC Partners. RTC is an independent sponsor. We've been at this since 2016. Got our first platform off the ground in 2017. And since then, we've launched 6 platforms, completed 80 acquisitions across those platforms, all in the vein of highly acquisitive buy and build strategies, primarily focused on services industries, where we can find a high degree of fragmentation, benefits to consolidation, and the opportunity for significant multiple arbitrage as we scale from lower middle market starting points to mid-market exit points.
Thanks. And I mean, as you're looking at these opportunities and just day one, you go in and you're trying to increase value, how do you ensure just kind of going in that you can have a strategy that's going to create value, then also just make sure, since you do buy and builds, just ensuring your close rate, because that's so important to your process?
Yeah. So, the way we start each of these, and I think underpinning everything that makes them work, is a really thesis-driven approach from the beginning, right? So we spend a good 6 to 12 months before making an acquisition in a new industry in a given strategy. And I should say the way that we set these up is during that thesis development process, we go out there and we raise a dedicated pool of capital that's going to be committed fully to this upcoming strategy. So we kind of joke that it's a myopic pool, not a blind pool of capital. And we spend that time doing a couple things that really help drive the success ultimately. One is we go out and we recruit an operating executive that's an industry pro that's going to be able to help run this platform from inception through exit and really help us hone the strategy. We don't try to pretend we're going to know more about an industry than the pros that have done it for a long time. And then as part of that, we do a lot of industry mapping. So we really want to understand in these highly fragmented industries what's out there, how the service lines break down, how the end markets are performing, and really come up with a robust map of what the target universe looks like and how we want to prioritize that. And that really helps us kind of get in with a leg up on visibility to how we're going to get to scale quickly as we launch.
Got it. And so since these operators that you bring in for these specific platforms, it sounds like that's extremely important to your strategy. How do you ensure you're kind of getting off on the right foot with these operators, setting the tone early? Do you have any best practices or processes you've used in finding these individuals and then just making sure you kind of set the stage and the tone for how you're going to create the value?
Yeah. So look, we're typically trying to scale from kind of lower middle market starting points, $25 to $50 million revenue entry points, up to 500 million plus exit points, so true mid-market platforms. And to do that right, you need executives that have played that game before, understand the M&A playbook, and what great looks like through that process. And so that requires running a pretty robust recruiting process. We tap executive search firms and our networks to try to find the right person. But then most importantly, we're looking for execs that are willing to co-invest and really put a lot of their own capital into what we're trying to build as more than anything, a token of their belief in this strategy and kind of dedication to making it work. And we look for ones that have done this through their whole career and are looking to kind of make that capstone on their work and kind of have their magnum opus at the end of it, building something new.
Got it. So, I mean, I think buy and build, a lot of people understand, yeah, it seems to make a lot of sense to make acquisitions versus, organic growth can be very difficult. But there's also potential risks with, add-ons and buy and builds because you got to integrate these companies. How do you guys early on kind of go in and make sure you're diversifying, lowering risk, and still keeping an eye on organic growth?
Yep. So there are few major risks that often cause these type of strategies to fail. The first is that you stall before you get to scale. So you get the first and second acquisition done, you struggle with organic growth, maybe you put too much leverage on, and you have trouble getting to the third, fourth, and fifth, or you don't have the visibility and the deal flow to make that happen. So we mitigate that by spending a lot of time up front to build that pipeline and have visibility into, hey, here's a dozen targets that we're advancing in conversations with before we make the first few acquisitions. And usually we have 1, 2, 3 under LOI before we really dive in. So that's a huge piece of it. The second major risk is around integration risk. So people acquire a bunch of companies and they end up with a holding company that really maybe makes sense together, but isn't coalescing into something that where the whole is going to be worth more than the sum of its parts. So we get ahead of that by really investing early on in the corporate infrastructure and the executive team that can help integrate and manage that. So we start with that professional CEO that can run it, but then very quickly, and usually before launch, we're hiring a top-tier CFO that's done a lot of back office building and integration, and quickly layering in a CHRO and a COO, the team that can run this at 500 million early. Now that takes finding good debt partners that understand that you're going to be investing into a J curve ahead of growth, knowing that you have a good view of what great looks like at the end and the confidence that you're going to get there. And then the other pieces are a little bit more target specific. So, when you're acquiring these subscale pieces, trying to build into a scaled organization, they often come with key man risk, which is one of the biggest ones. And so we lean really heavily into employee ownership through rollover equity and other employee equity purchase programs to make sure that we're really aligning interests and incentives across the platform. And that typically equates to somewhere around a quarter of our employees owning equity, and collectively with management owning a good third of the overall platform, which does a great job of mitigating that risk, does a good job of forcing those conversations to make sure you have strategic and long-term alignment on the goals of what you're building from the beginning. And we found that to work really well. And then the final is just, when you're buying these subscale entities, they often come with high customer concentration risk. And that's really about taking measured risks in that regard, right? So in the early stages, you probably want to avoid it like the plague. As you get to scale and you're already at 100, 150 million revenue, you might be able to afford to acquire a small entity that has some customer concentration risk. If you've diligenced that really well, you understand the base of the contract, the relationship, the outlook, and you can slot that into a more diversified organization already so that the effect of variance there is not going to tank you.
So it sounds like a key way you do things is making sure you have aligned incentives with more than just the key management, but pretty deep into the organization. Do you guys have folks buying in? Are you giving them management options? How are you awarding this equity, and how deep in the organization does it go to? Does it go to all your C-level? Does it go to mid-management?
Yeah. So we use a management option pool for kind of top tier leaders to start. And then as you begin to scale and grow, there'll be new kind of more senior level leadership positions that open up where you're going to want to provide that additional incentive. But the primary way that we do it is through rollover equity. So simple transactions that are cash and rollover. We often use rollover as a gauge for how bought into the go forward strategy these leadership teams are. So we'll say, look, we can offer you up to 30% in rollover, and we'd like to see it at least 10. Why don't you let us know where you want to wind up there, and that'll be a really good gauge as to where they are. Then through the transaction process, we run multiple on-site workshops and try to penetrate down into that second and even third tier of emerging leaders in these organizations to really get a sense of who the key players are. And in the cases where ownership is not already diversified in the underlying organization, we will urge those owners to use the transaction process to funnel some of the proceeds as equity into their key leaders' hands. And so that helps diversify everything from the start.
So you get them kind of on. So if you're sitting down with an owner, you say, hey, look, I want you to take some of your proceeds, reward them to your key people, try to get them on board and explain how important that is to them to grow that second bite of the apple, kind of?
Exactly.
So they got to be on board with it.
They got to be on board, and that to us ends up as a kind of a self-selecting process. The owners who are just really interested in maximizing deal value for themselves and taking chips off the table are not the right ones that are going to fit in the longer-term strategy of what we're building. The ones that come into it and say, look, this is as much about a happy place for my employee base and my legacy going forward are the ones that either have diversified it already or are really open to doing that as part of the process.
It's pretty interesting. Have you ever had anybody throw you out and say, no way?
Yeah, I mean, we've killed deals because people were unwilling to do that, and it belied kind of what their real motivation was. We found kind of one of the biggest killers in these are big ego toxic personalities that can poison the well pretty quickly, and so we try to weed them out, and this is one way of doing that.
Never met a founder with a big ego.
The other piece that's helpful there is, we tie pretty punitive clawback terms to that equity, right? So we say, look, we're being very transparent on what we're trying to build here, and we want you involved if you believe in this longer term strategy and are excited about it and want to be a part of that. And that means committing to whatever that is, 3-4 year employment agreement to make that work. And should you decide to leave before that, we are going to want the option to buy that equity back at a punitive clawback price.
What if you get working with this founder and you think they're extremely important to the business and you find out they're really not that good and maybe they're toxic to the environment? What do you do then? You have an employment agreement. Like, do you stick them in a corner? Like, do you get them some counseling, coaching? How do you deal with that? Has it ever happened?
Yeah, it happens a lot. So, not a lot, but it happens enough that we've had to deal with it quite a few times. I think the first is back to the point of kind of diversifying that key man risk through the transaction process, understanding that we want to acquire organizations that have a deeper bench, that have that second level of leadership that's ready or on their way to being ready to take things over. So that helps mitigate that up front. When it becomes clear that one of those founders is not able to play well in the new sandbox, our experience is you want to move quicker than not on that and phase them out. And what we found is, you've done those two things right. You have that extra team. You have maybe a toxic type leader. Moving them out is actually to the platform's benefit. Those folks have been often just waiting for that opportunity for years, and it helps.
So when you're looking at these businesses, it sounds like you identify a pipeline of opportunities, and then you're also looking at the M&A side, but you're also looking at the organic side. Do you guys use like a buy side firm that comes in and finds these opportunities kind of out of the gate? And also, when you're looking at the organic side, do you bring in anybody externally, or is it just you and your partner to look at, hey, how can we accelerate organic growth in case some of the buy and builds don't work? You want to make sure you have an organic strategy. Do you bring any outside consultants, advisors, or anything like that?
Yeah, so a couple things on that. So first, on kind of identifying the targets that are going to be strategically complementary. And the way we're typically building these is we think of strategic complement in terms of geographic diversification, end market diversification, and service line diversification. So if we're pulling together companies across those few metrics, we're widening our aperture of what we're able to approach. And as we get scale, we were able to grab higher share of wallet with each of those customers and make things more sticky. I talked earlier about kind of mapping out the industry landscape and trying to understand everything that's out there. One of the things we've been doing, so a few things we've been doing. One is we do always try to identify those boutique investment banks that are really kind of the gatekeepers for these industries, the dedicated banks that have done nothing but engineering services. And we will get them on contract for buy-side agreements because they really can be the best source of knocking on doors and getting you connected with off-market opportunities there. We've also been using artificial intelligence tools that we're able to feed criteria of what we're looking at, and they're able to then scrape the web and use LinkedIn data and website data and news articles to try and identify, hey, here's the 10,000 firms under these NAICS codes, and here's what each of them do, and score them based on priority to what we're trying to build. So that's really helped. So when you start with that core of kind of really understanding how the pieces are going to fit together and having a good view of what everyone does as you bring them in, you have your base to start driving that organic growth. But as you get the ball rolling, the thing that we found is the most helpful is, any one of these leadership teams that you're acquiring in often has a pretty good idea of firms they've partnered with in the past or firms that they know of that they know would be a great strategic complement to what they're doing. And so we put incentives in place and we really try to drive a process to garner that off-market deal flow and bring in those known entities. And that ends up being a pretty huge piece of the deal flow.
That's interesting. And I think one thing that differentiates you guys is the way you raise capital for a specific strategy for this buy and build, and your investors are behind it at the beginning. Hey, we know we're going to go after this industry. We're going to make a bunch of acquisitions, and they're pretty specific investors. Do you know any other firms like you? Because most people here, are independent sponsors. People raise money deal by deal, but you raise it and it's for a specific strategy. And it's a committed fund of like 50, 100 million that goes after a particular kind of strategy.
Yeah. Look, when we first got started and got the first platform off the ground in 2017, it was passing the hat with high net worth individuals and families that were willing to take a flyer. But as we've evolved and had a lot of success on these strategies, we've gotten to the point now where we can develop the thesis, get out into the marketplace, and we try to raise the full equity capital that we need up front to scale from that lower middle market, and that's typically 3 to 8 million EBITDA up to, we're typically targeting somewhere around 50 million EBITDA at scale, and we know we need 75 to 100 million in equity to make that happen.
So if I'm one of your investors, it's just a commitment and you call the capital as you need it?
Exactly.
Okay. And are these guys like ex-executives in particular industries that you've worked with, or are they family offices? What types?
Most of them now are larger institutions. So, I think what we're seeing in the independent sponsor market is that, the large allocators are developing their direct investment arms. One, because they know great independent sponsors are driving outsized returns in the marketplace. But then two, it's a way of developing those relationships, vetting these sponsors early on in hopes of getting into their first larger commingled vehicle. And so we have a lot of groups like that.
Great. So let's say this all works out. You raise the money, you do the platform, and you take it from 3 to 50 of EBITDA, and you're trying to get, trying to get max value now when you sell it. How do you start pre-marketing your business? Any strategies you can share with us? I think a lot of people are about preparing to sell their companies. A lot of independent sponsors here that have deals. Any ideas or strategies you can give the group on pre-marketing their business to kind of generate some steam?
Yeah. Honestly, for us, that starts as early as the thesis development phase, right? So connecting with those larger mid-market, large cap investment banking groups that are selling these organizations at scale are the ones who kind of best understand what great looks like, what's driving premium valuations in these marketplaces, and we bake that into the thesis development, right? Then from there, they're also great sources of, hey, let me introduce you to, you know, Lars at New Mountain, or, you know, they know the groups that are competing for each of these deals at scale. And importantly, they know the ones that have invested a lot into it, but maybe lost out on the last transaction. And they're also hosting a lot of the large business services or industry specific conferences where there's speaking spots and opportunities to connect your executive team. And so we start doing that very early on and creating those feedback loops and relationship development with the most likely potential buyers and our platform. So by the time we're ready to go to market, they know us, we know them, and
Okay.
we're set up.
So you're talking to potential buyers pretty early in the process, and you kind of know what they want, and you're trying to build that.
Yeah, exactly. And then you have the feedback loop of, you know, hey, look, you didn't end up doing this one. What happened? Well, this one had overexposure to the federal market, and, you know, we're off that right now for these few reasons. And so that can further inform our inorganic growth and investment strategy as we continue to build.
Got it. So it sounds like you guys, I've heard you say what good looks like a couple of times. So you go in and you almost map out what these businesses are going to look like, and you know, hey, if I expand into this geography, it's going to increase enterprise value. If I diversify, so you pretty much know what the plan looks like, and then you're just going out and trying to execute that strategy.
Yeah, that's exactly right. And then, you know, you have to be opportunistic in these. And so there's always going to be interesting things that come up. Like right now, we're chasing a large transaction in Puerto Rico for one of our platforms. And that would be kind of a jump into a new geography that's a little bit tangential to the core. And so we, again, can use that investment banking community and all of these potential buyers as a feedback loop to, okay, how would you view this on exit? What are the risks that you see associated with it, and how should we be trying to mitigate that as part of the deal process, or avoiding it if it's something that's ultimately going to depress value on exit?
So you kind of know that you're talking that feedback loop with potential buyers. Hey, we don't. You make that acquisition, that's going to increase value. It's going to hurt value. That's pretty important to your process, is having that live feedback.
Yeah. Always building with the end in mind is key.
And I think probably last question, so we have 5 minutes left for questions. But have you had any surprises? You know, I guess when you have these engagements, these early engagements, have you had any surprises with buyers along the way?
Surprises are the things that kill the deal process. And so, you know, in these strategies, the way we're executing them, we talk a lot about it being a partnership model. So we're bringing together a bunch of peer organizations to build something new together. And so we want to be kind of very upfront and transparent about what it is we intend to build and how we see them fitting into that. And then we try to translate that into how we approach the deal process. We're partners from day one, and though it seems like we're sitting on different sides of the table, we're really going to end up on the same side of the table here. And so what we try to do with that is take a really pragmatic approach to the deal process. So the first thing we do is we sit down and when we have the deal kickoff call, we lay out from end to end, here's everything that's going to happen. Here are the major kind of pitfalls that you might run into. Like, hey, here, we're going to tell you up front, here are the punitive terms on this equity. And if that's going to be an issue, we want to address that right now so that it doesn't become an issue 60 days in and we waste our time.
Have you ever had one of these potential buyers say, hey, you know what, we like what you're doing, let's just stop, can we just buy it sooner? Maybe you're at 20 but instead of 50, and it's the advantage potentially of having them around the hoop is maybe they just get excited and come in too early, or has that ever happened?
It just happened. So we just had our highest performing MOIC exit, and across our first three, we've blended at about a 4.25 x MOIC, and this one was about a 5.5. And it happened because we have had one group that has been following the organization for several years, really got to know the management team, We invited them down to our annual executive retreat that we host across the portfolio, and they really formed a connection. And we were getting ready to go out to market about 12 months ahead of when we actually did the transaction. And they stepped in and they said, "Look, we have a lull right now, and we need to get some capital to work. And you're at the top of our board. And so if you give us a chance, we'll take a big swing at what we think will be a market clearing multiple for you down the road." And it worked out.
So I guess like along this way, you've identified these potential buyers through investment banks, through these relationships. When that happens, and let's say I'm the investment banker that kind of brought you to these potential industry affairs, you met the buyers through. What do you do with me? I'm the investment banker, and I kind of introduced you to all these potential buyers, and you didn't even need to run a process. Do you need to throw me a tip, or is it, hey, get you on the next one? How does that kind of work?
Yeah, everyone's got to eat.
Yeah.
So, you want to take care of your friends and partners that are helping you throughout these processes. And of course, when you do go to the full marketing process, those are the ones that are going to get the preferred treatment. But in the cases where you're able to do it off market, you want to find ways for them to add value through that process, maybe help with some of the diligence processing and earn.
Yeah, I was gonna say, if you even have like a handshake deal or with a potential buyer, do you still have an advisor to help guide you through the process of an exit?
Yeah, there's such big, robust processes. There's so much diligence that needs to be done that having that support never hurts. Now, you're not going to pay a full fee on that, but
right. Yeah, that's good. I've heard some of these fireside chat roundtables where sometimes buyers will cherry pick, these companies, and I'm of the same mindset. Take care of that investment banker that made that connection, or else you're not going to get the invite to the next one.
Yeah,
right?
it's all a relationship game.
100%. Well, good. Well, I think you shared some fantastic ideas for a lot of people. So really appreciate it. Do we have any questions? We have a couple minutes left. Any questions?
Yeah. First off, very helpful conversation, guys. Thank you both. Tony, you mentioned as you target industries, looking at advantages of scale, whether that's fixed cost leverage or deployment of technology. I don't know what that looks like, and fragmentation, because you have to find a lot of these bolt-ons to move up to get the scale you're looking for at $500 million. Can you talk a little bit more, maybe one step deeper, about industry selection and what that looks like?
Yeah. I think for our specific type of strategy, there are a few things that really unlock value. Some of them are obvious, right? So we look at large, mature industries with a huge degree of fragmentation, which provides a wealth of targets. And you want to have that for pretty obvious reasons, because the more targets out there, the more opportunities for shots on goal you have, and the better opportunities you have for getting a nice entry multiple on all of that. And then the multiple arbitrage piece is also pretty straightforward and easy. Understanding what these scaled organizations are trading at once you hit those certain size thresholds, and there's often an obvious correlations between scale and diversification and valuation. That's easy to underwrite. And so those underlying dynamics you can find across a lot of industries. I think where the rubber really meets the road is underwriting those benefits to consolidation. And so, where we really focus is on top line synergy. So we want complementary organizations. I'll give you an example. So engineering services, we built a large water, wastewater, and transportation engineering firm called the Ardura Group. And what we saw in that industry is that the way these firms compete for public work in an RFP process is based on their core of resumes and experience within the organization, and having geographic presence to be able to execute on that. So if I buy a water treatment facility expert in Florida, and then I also buy a conveyance expert in South Carolina, all of a sudden I'm able to compete for water treatment and conveyance in both of those markets. So we're looking for kind of those types of top line synergy potential, and identifying those really, and then the feasibility of executing on those again goes back to partnering early with industry experts who have lived that and understand it. And then the other piece often comes with trying to figure out how to drive margin through scale. So people always think about the more obvious aspects of that, which are kind of your fixed cost, blending your insurance costs down, or benefits costs, or facilities costs over time, which you can certainly squeeze a few hundred basis points of margin out of that often. But the less obvious ones are on, especially in services industries, figuring out utilization of resources appropriately. So trying to understand how to implement more sophisticated systems and business processes to help you do and execute more work with fewer resources and a lower cost base on the human capital side. And that's where really kind of the hard work of thesis development comes in.
So it almost sounds like you're looking not for just geographic diversification, but adding to the menu of services that you can sell. If you know there's wallet share and your customers are potentially a customer for another product line, you like to diversify the revenue stream and get more share with your existing customers.
Yeah, exactly. And those ideas always come out of conversations with targets. The early questions that we're asking them are, well, what other services could you be selling to your current clients? And that can inform the strategy in the best way.
Great. Good question. Any other questions? I mean, I'm learning a lot up here, so.
How much do you allocate to the management pool?
So we don't fix it up front, but it usually ends up at about 10%. Pretty standard.
The question was, how much does he allocate to the management pool?
The one thing that we do a little bit differently, in addition to that, is we put an employee equity purchase program in place at each of our platforms. And so the way that works is more junior employees, emerging leaders throughout the organization have the opportunity to be nominated on an annual basis as an emerging star that should be part of the ownership team. And so that's a big process that the whole leadership team gets together, figures out who that is. We put about 1% of the cap table up for grabs, and we allow them to actually put cash in and buy into the cap table. And we found that to be actually really well oversubscribed every time, and a great way of kind of imbuing that ownership mentality across the organization and much deeper into the structure.
So they have the right to purchase, or the company's like, hey, you're nominated as a star and you make 50 grand a year. Like, how are they able to buy in?
We give them the right to purchase,
Okay.
and we align that program typically with the annual bonus cycle so that they're flush with cash and, see who wants
Interesting.
to
Is
put
it
their
a
money
couple percent of the equity or 1%? I mean, does
in.
it?
Usually 0.5% to 1% per year, but meaningful amounts relative to
They're
what
thinking like an
these-
owner. I mean, these are, if they truly are stars, if they want to buy some of the company, that's awesome.
Yeah, folks are putting, $10,000 to $50,000 in, but relative to the $150 a year that they might be making, it's meaningful investment, and it helps.
And just on that question, just to understand the different buckets, when the seller puts his potential capital aside for like that middle management, is that 5% of the capital stack? Is it 10%, or does that depend?
So on a deal by deal basis, it usually ranges from 10 to 30% in rollover. And then once you factor in the effects of debt on that, it usually means that on an aggregated basis, the employees' ownership own around a third of the platform at the end of the day.
Interesting. So when they're doing that rollover, some of it's allocated to them and some of it's allocated to the other players.
Yeah.
Interesting. That's a pretty neat model.
Yeah. Thank you.
That's unique. Thanks for coming so early, everybody. Really appreciate it.
All right. Thanks, everyone.